Good afternoon, everybody, and welcome to the Unity Renowned Speaker session this afternoon. Really excited today that we have Shaz Nawaz, author of the Property Tax Guide. I'm coming to you from my daughter's garden in London at the moment, so I'm playing about on the iPad. Normally I'm in the office, so hopefully this thing's going to work okay. And without any further ado, this session is going to be a mix between a presentation by Shaz and also a question and answer session. So if you come along equipped with questions on tax, then please pop them in the chat box, and when we get the chance during the course of an interval or whatever, then Shaz is going to pick up on those and answer those questions for you. So without any further ado, I'm going to hand over to Shaz.
Thank you very much, Rupert. It's a pleasure to be here, and thank you to everybody for joining us. I'll start off by talking about incorporation, and I know to some extent, from my point of view, I guess, I sometimes feel like incorporation has been done to death. However, every now and then, I still come across somebody who asks me a question, which makes it very obvious that perhaps they haven't thought through incorporation as they should have done. So just before I came onto this call, I was doing a strategy session with a husband and wife, and they own best part of 16 properties. And they started talking about incorporation. They've got quite a few properties which are on a fixed term period, and most of them are due to expire in the next 6 to 9 months, which seemed like a good opportunity or time to obviously incorporate. So as we go down the road of the conversation, and near the end, they then tell me we've got £400,000 worth of losses in our own names from our rental business. And that's when I stopped them in their tracks, because I said, you're looking to obviously mitigate the Section 24 tax charges, but you've got £400,000 worth of losses. That's going to take you a certain number of years to use up, to suck up those losses. So why are you so fixated on incorporation? And they told me they'd spent so much time researching it, and up until now, either nobody had brought it to their attention, or they hadn't thought about the fact that they weren't able to take forward their losses from their own names into a limited company. And that does happen from time to time, where people don't always think through all the different steps when considering incorporation. So I would encourage you, if you're at that point, by the way, of thinking of whether or not you should incorporate, think through all the different steps and all the different considerations to make sure it works for you. I've taken loads of calls in the last 4 odd years where people have thought incorporating their property portfolio was the best thing for them to do, and it actually wasn't, for various different reasons. In fact, about 2 weeks ago, I took a call from, again, husband and wife, and they've built a pretty decent portfolio of, I think, 26 odd properties in the Nottinghamshire, Lincolnshire, that type of area, and they were, again, keen to incorporate. And I established that they had fixed rates periods on about 11 of those properties, and they're due to expire in about 3.5 years' time on average. And I was trying to kind of veer them away from talking about incorporation to say, find out what the fixed rate penalties are going to be before we have this conversation. But they were adamant, no, we're going to talk about this today, and we want to make sure we want to do this irrespective of what the penalties are. Well, we've gone through the conversation, discussed everything, they're pretty happy, they're sure they want to incorporate. They then go to, and find out from their lenders £120,000 in penalties if they repay those loans to incorporate. Again, a showstopper. So those kind of things appear quite often, and it's important you cover those before you actually incorporate. Now, there's a particular school of thought, in fact, that says you don't have to refinance when you incorporate. You can have a deed of trust to do that. Now, legally, that's absolutely fine, and those commentators are right. You can have a deed of trust and pass over the beneficial ownership into a limited company and legally still remain as the owners. The crunch point is, if a case, as and when it's taken to tribunal, HMRC will argue this wasn't a bona fide transaction, and then we'll try and fight tooth and nail to prove that the spirit of the law wasn't followed in terms of how Section 162 incorporation relief works. So people don't have to refinance. They can move their properties into a limited company. Is that going to work? My personal opinion is I think we'd have a problem. But I know there are tax commentators out there who have a different view, and that's fine too. And that will be proven if and when a case goes to court. Now, above and beyond, of course, Section 162 incorporation relief, one of the big advantages, and I don't want to spend too much time going through this today, but if it's okay with you, because it starts getting complex. But one of the big advantages is when you move your properties from your own name, or your names if there's two or more of you, into a limited company, you get an uplift in the base cost of those properties. And that can have a huge advantage. So put simply, if you've owned properties over a long period of time and they've appreciated in value and the equities more than the debt, then there's good reason for you to incorporate in terms of A, the increase in the base cost, and B, of course, the value of the shares that you're going to get when you move your properties from your own names into the limited company. Some of the other advantages, which I'm sure you'll be aware of, are things like, obviously, you've got limited liability. Section 24 doesn't affect you. You can control your income because when the properties are in your name, you actually pay the tax on the profits. Whether or not you use those profits for personal purposes, it matters not. Whereas, of course, if you have a limited company, you only pay income tax on the profits or the cash that you take out. So if you take a salary and then you take a dividend, you can control how much of a salary you can take. You control how much of a dividend you take every year. So you can control your income tax. Of course, the flip side to that is you pay corporation tax at 19%, and then you may end up paying income tax on top of that, depending on how much income you take. Something which people use incorporation for really well, and we have done this over many years and well before Section 24 was on the radar, is to incorporate the property portfolio and then to use a trust to pass down the estate or the assets to your children. So if you are thinking about incorporating and you do have children or other family members to whom you want to leave your assets, then don't just stop at incorporation. Go that step further and fully consider setting up a trust to see what benefits that has for you and if that works for you. And again, on the flip side, generally speaking, when you refinance, you'll have to, obviously, you might have to pay a higher rate of interest as compared to the properties being in your own name. You might have to pay stamp duty, land tax, unless you're a partnership and the partnership incorporates. So that's something to bear in mind. You'll have, obviously, legal fees, and you'll have to pay arrangement fees and valuation fees. So I've kind of quickly gone through that on the assumption that most of you either have covered this in the past, or if not, you can ask me questions and I'll be happy to answer them. But there's lots of information available out there which will hopefully point you in the right direction. So tread carefully when you're thinking about and looking at incorporating your property portfolio. Just because everybody else is doing it, it doesn't mean it's right, and it doesn't mean it's right for you, because every situation and every circumstance is different. And in tax, there is no one size fits all. So Rupert, if there are any questions from anybody on incorporation, I'll happily take them as we go along. Feel free to interrupt me. Above and beyond that, I had a question from somebody in terms of they're looking to buy a piece of land. The land has planning on it for residential properties. The land has an option to tax, which simply speaking means the vendor or the seller will charge VAT on the disposal. And the question was, do we have to pay the VAT? And you'll probably know by now that an accountant and a lawyer's best answer and friend is it depends. So if there's an option to tax on this particular transaction, then one of the first things the buyer can do is ask the vendor to disapply the option to tax. Now, they may or may not want to do that, but that's an avenue you can explore. Secondly, depending on what the land was used for, you could do a transfer of going concern. So if it's farmland, or if somebody's growing crops there, or if the land is used for grazing, or then you could do a transfer of going concern, which will enable you not to pay the VAT on the transaction. Because obviously paying the VAT brings its own challenges in terms of you need to fund the VAT. Then if you get it from the bank, you've got to pay interest and arrangement fees. And then of course you then need to get that VAT back from HMRC. So a transfer of going concern avoids you taking all those steps. If failing those two avenues, your third one, of course, is to pay the VAT, then register for VAT and reclaim the VAT back on your first VAT return, because you may or you may not know that the disposal of residential properties is zero rated. So when you build those properties, you can reclaim the VAT that you pay on the purchase of the land and any associated costs that you have in terms of building those properties. So that's the answer. The second part of the question was, do we have to pay stamp duty land tax on the VAT element? And the answer is yes. So another benefit is if you can avoid somehow paying the VAT, then it's in your interest, because not only do you not save the hassle of raising the funds, paying the interest, the arrangement fees, getting the money back from HMRC, but you'll also pay or less stamp duty land tax. So if you are buying a property for £1 million, you pay stamp duty land tax on the £1 million. When I say property, I'm including land. If, however, there's VAT on it, then you would pay stamp duty land tax on the million plus the VAT element, which in this example would be 200,000. So you pay stamp duty land tax on £1.2 million. So not paying the VAT has the advantage of where you save the stamp duty land tax element too. So again, Rupert, I hope I've covered that. But if I've missed any part of that question, Rupert, feel free to remind me. Do we have any questions so far?
That's great, Shaz. And yes, please, if people could type in their questions to the chat box, or that would be great, and we can get Shaz going with that. We have one at the moment from Robert Cope, who says, if you're not VAT registered and buy a commercial property that is VAT applied, VAT elected, can you reclaim the VAT without being VAT registered? Well, I think I know the answer, but I'm going to leave that to you, Shaz.
Yeah, so let's widen the scope of that question with the view of trying to be more helpful. So if you're buying commercial property and your intention is to then convert it into residential, then what you could do is you could complete a VAT 1614D, give that to the vendor, which tells them that you're going to convert the property, and then you don't have to pay VAT on the purchase price. If, however, you're going to use the property, and of course the other bit that I've shared with you in terms of the first answer, in terms of buying the land and then reclaiming the VAT, you can do that too, but then that means you have to pay the VAT first. The other side, of course, is if you're buying commercial property and your intention is to leave it as commercial, then if you want to reclaim the VAT, then you're going to have to register for VAT in order to reclaim it. Now, on smaller transactions, sometimes what I have seen is people say they're not too fussed about registering for VAT and making a reclaim because the figure is quite small and they don't want the hassle of filing, say, quarterly VAT returns going forward. And in that case, they end up paying the VAT and don't reclaim it back. So for you, Robert, I don't know how big the transaction is, but generally speaking, I'd say property, let's say just the majority, 99% of people who buy commercial property with an option to tax end up registering for VAT and then reclaiming the VAT they paid on the purchase. But then going forward, there's two things you have to do. One is charge VAT to your tenant, and then secondly, because the option to tax will apply for 20 years, you'll then have to charge VAT if you sell the property on.
That's great, Shaz. And yeah, I think there's a kind.
We've lost you, Rupert. I can't hear you, Rupert. So
Is a vessel.
Rupert, I can't hear you, so I'll assume nobody else can hear you.
It's normal tenants that might be operating below the VAT threshold. Then, hello. Sorry if we've lost on that one. So.
Yep, I can hear you now, Rupert.
Yeah, sorry. So just saying on the rule of thumb that the smaller properties where the tenant is likely to be not VAT registered, then they tend to be not VAT elected. But in the main, those properties where you have a VAT registered tenant, you'd have a VAT elected property, and then you can get all the benefits of refurbishment and VAT back and everything like that. Now, carrying on from that question, we've got, what if you buy some land in a limited company and intend to apply for planning permission? Is there an efficient way to limit planning capital gains, assuming the limited company decides to sell the land in the future?
Again, that's a very broad question, Rupert. If the question is the first thing is companies don't pay capital gains tax; they pay corporation tax. I don't fully understand what Bilal's trying to get to, but I'll reframe the question with a view to helping Bilal. And of course, if then Bilal wants to add something extra in the comments box, we'll do that. So I'm assuming Bilal's question is, there's land in a company, which obviously he's made very clear. If we then obtain planning, sell that piece of land, we've made a gain, the company would pay corporation tax on the gain. And my assumption is, Bilal is then saying, if I want to take that money out, how can I reduce my tax exposure? Because obviously if he wants to leave the money in the company, he pays corporation tax, then he can do what he likes with that money, well, obviously within the wrapper of a limited company. Something you can look at doing, Bilal, if you wanted to get your money or hands on all the money, is you can set up an option agreement with the company where you agree to buy from the company at a fixed price. You then obtain planning permission, okay, and then you see an uplift in the value of the property or the land in this case. You can then assign the piece of land to a third party, i.e. the person who's going to buy, and then you're selling to them, and the company is selling to you, although you've assigned the option. So when you sell, most of the money will come to you, and you'll pay capital gains tax personally, and depending on whether you're treated as a trading activity, if you are, you'll get to claim entrepreneurs relief, which has come down to £1 million, and now it's called business asset disposal relief. Before the 11th of March this year, it's called entrepreneurs relief, and you'll pay 10% tax. So that's a very efficient way of you doing this, but it requires a good option agreement and a few steps to be taken. So that's going to mitigate the overall amount of tax that you pay, and the big advantage is you get all the money in your hands. If, however, you're not too interested in getting the money in your hands, then obviously allow the company to pay corporation tax and leave all of the cash in the company. But generally speaking, what I find is once people have entered into a transaction, had the gain on the planning, they sometimes want to take some of the money out. So using the route I've just shared with you, is going to be very tax efficient. Because if you don't do that, then you're going to pay 19% corporation tax. Let's assume you've made a 200 grand gain. If you take out the £200,000, you're then going to pay income tax on the £200,000. Depending on your overall income, some of that would be taxable at 7.5% if you're taking it as a dividend, some at 32.5%, and some at 38.11%, I think it is, as an additional rate taxpayer. So you can avoid all of that by claiming business asset disposal relief and only paying 10% tax.
And I think you mentioned, Shaz, just earlier, you mentioned about getting the 10% entrepreneurs relief. Am I correct there?
Yeah, that's correct. I mean, they've changed the name now to business asset disposal relief, but yes.
Right. But I believe that if you were to do that, then you really should not be repeating the same or being in the same business for a period of at least 2 years. Is that correct?
So that applies if Bilal was to leave the money in the company, liquidate the company, do an involuntary liquidation, then claim entrepreneurs relief, and then take the money out. Then you're absolutely right. Then you can't go into this same trade for the next 2 years because you'll recall, Rupert, that the use of Phoenix companies used to be quite popular. Everybody used to liquidate, and then next month or whatever, 2 months' time, they've started a new company. So there's targeted anti-avoidance rules called the TAR, which stop that happening. So if you liquidate a limited company, claim entrepreneurs relief or business asset disposal relief, that then stops you going into the same trade for the next 2 years. But the opportunity that I've shared with, or the option that I've shared with Bilal, which is having an option agreement in his own name before the planning goes through and then assigning the option to a third party, that's not going to stop him doing similar trades going forward.
Right. Okay, that's good. And the following on from Andrew Hall's question earlier about the VAT, he also would like to ask a little bit and understand a little bit more about capital allowances. And one thing that comes to mind when you're talking about structuring within a limited company is that if you are to get considerable capital allowances on this piece of land or this building that he's buying, that depending on the tax status of who's owning it, obviously the value, the real value of the tax credits could differ quite greatly, because a limited company, you're only going to get 19% relief on your capital allowance. I think relief is probably the wrong word. I think it's credit. But of course, if you had it in your own name and if you're a higher rate taxpayer, then that could be considerably more, could it not?
Yeah, absolutely. And this is a key consideration and a good point that you raised, Rupert, because a lot of people who are property investors tend to veer into service accommodation, which you'll know has many different advantages. One of the big ones, obviously, if you make it work, there's a big cash flow advantage. And you're absolutely right. So let's say you've got, I'm going to keep this really simple now. Let's say you've got £1 million worth of capital allowances. If they are stuck in a company, then you're going to get 19% corporation tax relief on those. So the benefit to you from a tax point of view is only £190,000. If that same the same amount of capital allowances are, say, in a limited liability partnership, and you become higher rate taxpayers, then the advantage to you is not 19,000 like the company, it's 190 grand, sorry, it's 400,000 because you're higher rate taxpayers. And if you're additional rate taxpayers, it would be £450,000. So depending on which rate of tax you pay, there's a bigger advantage if those capital allowances are in your own name. Now again, the flip side to that, of course, is if you're making huge profits or substantial profits of, let's say, £100,000 every year, if those profits are in a company, the company only pays 19% tax on it. If obviously those profits are in your own name, then half of that income would be taxable at 40%. So there's a benefit, but you also need to look at the flip side. So if you're buying lots of properties, for example, which attract capital allowances, like the earlier question about the commercial property or service accommodation, and you're building up your capital allowances every single year because you're building up the number of assets you own, then you can write them off against your profits, personal profits every single year, and possibly not pay tax for quite a few years, but have access to all the cash. And let me just put that another way. Let's say you're running your business or through a limited company, and the company makes £100,000 worth of profits, and you write off £100,000 worth of capital allowances. So there's no taxable profit. So the company pays no corporation tax. However, if you now want to get your hands on that money, when you take the money out, you're going to have to pay income tax. If that same deal was, say, as a sole trader partnership or a limited liability partnership, you've made £100,000 profit, you write off £100,000 of those profits using your capital allowances, your taxable profit is zero, but that £100,000 is now yours. You can do what you like. You can buy a new car, you can go on holiday, you can pay off your mortgage, pay off whatever you like. So that's the big difference in terms of using capital allowances in your own name versus having capital allowances in a company. So
and that's really interesting. And from a structuring point of view, it is a bit of a labyrinth because whichever way you turn, there's a plus on one side and a minus on the other side. But a recent commercial with Uppers project that I did, the end destination for this property was to be in my SAS pension. But I actually bought the property outside of the pension in order to get the capital allowances. And then I could enjoy the benefits of the capital allowances outside of the pension. And then I had to transfer it into the pension, which then attracted a little bit more stamp duty, but it was eclipsed by the saving on the capital allowances. So a simple little thing like that, rather than just buying it straight into your SAS pension, by structuring it in a way like that, you can actually get some really good tax credits.
You're absolutely right, and I've seen on numerous occasions, Rupert, where basically people have bought a commercial property through their SAS, then they hear about capital allowances, and they come and speak to me and say, can we claim capital allowances through our SAS? Well, obviously, you've already answered the question, but the answer is no, because a SAS doesn't pay any tax, therefore there's no capital allowances available to it.
Yeah. And I think,
if I could just sort of quickly link that to the earlier question Bilal asked, and if he has a SAS, what he could possibly do, and again, this is complicated, so I'm going to simplify it just for the purpose of sharing the example, is he could have a structure, a joint venture or an option structure, where he personally, for example, owns some of the land, and some of the land is either owned by the SAS, or there's an option agreement there, or there's an overage agreement, and he can shelter or move most of the planning gain into his SAS, which obviously your low Rupert means he's going to eliminate or reduce or eliminate his tax. So that's something for Bilal to think about.
And I think that very much with people coming out of COVID-19 wondering what to do with dare I say it, their bounce back loans, or just generally how they're going to move forward with the opportunities that lie ahead. It does seem to me that whilst the high streets are looking a little bit dodgy, and from a tenant's point of view, I think that there are many good reasons to actually look at commercial property, because firstly, obviously the stamp duty is much less on buying commercial property, particularly if it's got the opportunity to build flats above. But with this capital allowances situation, to actually build up a good credit of capital allowances for the future could be a really important thing, particularly given the situation that we face at the moment, where the governments are having to bail us out and bail us out and bail us out. At some point in the future, they're going to have to increase tax rates in order to recover those revenues. So we may be dealing with 25% corporation tax in years to come. What do you think about that?
Yeah, absolutely. So your first comment about bounce back loans, Rupert, are you telling me people are have bounce back loans in their bank accounts and they've got no idea what to do with them, and they might invest them later.
Who knows? Who knows? All I know is the auctions are very, very busy right now.
But again, right now there's an excellent opportunity, because the former Chancellor Philip Hammond, what he did was, there's something called an annual investment allowance. And again, in very simple terms, what that is, that's the amount of allowance for capital allowances you can write off in 1 year. If you don't write it off in 1 year, then you've got to write it off in smaller tranches over a number of years. So as Rupert says, if let's say you buy a property and you identify £100,000 worth of capital allowances, and let's say now you refurbish the property and you've got another £300,000 worth of capital allowances, because it's a really big property. So altogether you've got £400,000 worth of capital allowances. What you can do right now, up until the 31st of December this year, you can write off those £400,000 worth of allowances right now in one go. What that means is, and let's say your profit every year is only £50,000. So you make £50,000 profit, you write off £400,000 worth of capital allowances, you've got a £350,000 taxable loss. So in your accounts, you're okay. You've still made a profit. On your tax return, you've got a taxable loss. So what that now means is, going forward, you can use those losses slowly as you go along. Now, if you weren't to claim all the capital allowances in one go, and let's say you only claim £50,000 this year to write off your profit, the other £350,000, depending on how we categorize those allowances, because different allowances have different rates. But to keep it simple, let's just say they're in the general pool, you can then only claim 18% of the £350,000 next year. That means you're going to use up the capital allowances slowly. So always try and make sure where possible that use up your annual investment allowance in that particular year. That means you can accelerate your allowances. So now, Rupert, I know you're going to say, what's the flip side? The flip side, of course, is if you've used up your capital allowances quicker than you should have done, if you then sell that particular asset and you make a gain on it, which is higher than the book value in your accounts or your tax return, then you'll have to pay what's called a balancing charge. So just be aware of that. But the likelihood of you selling that property in the next 2 or 3 years, usually, again, I'm generalizing, isn't going to be that high. So you're going to be okay. But bear that in mind.
That's really interesting, and I'm sure that when anybody that actually comes into that situation will be coming straight back to you for some clarification and detail on that. But that's fantastic to have in the back of the mind. And a couple of questions then. If I have, this is relating back to what you were saying earlier, if I have 150k worth of capital allowances on 2 furnished holiday lets in a partnership, can I offset that against 250k dividends from my limited company, which is not property related? Okay, so it looks like we've got a limited company. I'm assuming trading, a trading limited company, because it says it's not property related. We've got a partnership that has serviced, furnished holiday lets in, and the capital allowances are in the partnership. So he wants to offset it against profits in a limited company. I think one of the things that we're suggesting is that might not be the most tax efficient way of dealing with it. But of course, that's probably where the profits are sitting at the moment.
Yeah, you're right. That isn't the most efficient way of dealing with this. But if somebody's claimed their capital allowances, I don't know how much profit they've had. So the first thing, Rupert, would be they're going to use the capital allowances against the profit they've made in the service accommodation business, and then that's ring fenced to the service accommodation business. So it's not going to help them with their dividends.
Yeah.
Yeah.
And there's no way they can sort of shift those profits into the limited company for the purpose of the capital allowance.
No, because again, depending on how much profit they've made in their serviced accommodation business, I would say write off obviously the capital allowances against your serviced accommodation profits, and then use those funds for personal purposes, and that 250 grand dividend, leave that in the limited company account. Why would you want to take that out if the service accommodation business has enough cash to give you for your personal income?
Just generally on this sort of profit shifting, you might say, because it does feel very unfair where you've got 3 or 4 limited companies and that their fortunes differ from year to year, and that you're paying all the tax on one where you really would like it spread across to others. Is there a sort of a template structure that property investors ought to be having? For example, should they be having a holding company that is owning the shares in all of their other property-related limited companies that sit below that? And would that enable them then to shift profits across those companies?
Yeah, absolutely. So I mean, there are a number of benefits to having a holding company structure or a group structure. One of those, as you've said, is if one makes profit, the other makes loss, then you can write off the profits of one against the losses of the other. So overall, as a group or as an entity, you're paying less tax. Of course, if you don't do that, then one ends up paying corporation tax, the other one carries losses forward or 1 year back. And obviously, if you had losses in the previous year, then you're carrying those losses forward. So in order to accelerate use of those losses in the same year, have a holding company or a group structure so you can become tax efficient. But something people should be aware of is some lenders aren't too keen to lend money through that particular group structure, so it can be harder for you to obtain funding from time to time. So people need to be aware of that. The other obviously big benefit from my point of view as an investor, Rupert, is if you've made £100,000 profit in a particular company, and then that company wants to give a dividend to the holding company, you can pass, let's say you want to give a dividend of £50,000. So company A gives a 50 grand tax-free dividend to the holding company. Holding company can then push that money down to company B, C, D, or E, or whichever number or letter, and then you can do further investments. Now, people who don't have the holding company structure, and let's say they've got 4 different companies, if company A makes profit, if they want to use some of that for company B, then they've got to loan that money, and then before you know it, somebody's got 4 or 5 different companies, and then there's loans going left, right, center. It makes it difficult. You try and obtain funding, and then you tell the bank there's loans from intercompanies, makes it even more complex. Then if you're charging interest, it makes it even more complex. So the holding company structure makes that very efficient for you as well.
And I was going to ask you about the downside, and you've mentioned about the lending, because it does seem to me that the holding company has many, many more upsides than it does downsides. I suppose, your accountant might need some negotiation with regard to how much they charge fees for each company that you have. But one of the other benefits of a holding company is, of course, if you are doing different developments and different projects, that some of these projects might want to involve other people. And therefore, the holding company could be the shareholder of other SPVs. So it's very easy to then set up these joint ventures with other people in that way. Shaz.
Yeah, absolutely. And taking that one step further, although on the same path, if you've got different projects, then you obviously want to ring fence them, because as we know, in property things can go wrong. So the last thing you'd want is 4 developments in the same company. One goes horribly wrong, which impacts the other 3. Whereas obviously, if you've got 4 separate companies, if one goes wrong for whatever reason, at least the other 3 are ring fenced and they are safe. Above and beyond that, something else which most people don't know of is something called substantial shareholders exemption or shareholding exemption. And what that basically is, without me running through the rules, is if you have a trading group and you've owned the shares for longer than a year, when the holding company, Rupert, sells the shares in a company and meets the rules, all of that money is tax-free. Whereas obviously if you own the shares individually and you've got 4 separate companies, if you were to sell shares in company A to me, you'll have to pay capital gains tax on the uplift of the value of the shares. Now, generally speaking, when you form a company, you might have 100 shares at £1 each. So you've got £100 worth of share capital. If you sell it to me for £100,000, you've made a massive profit of 100,000 less £100.
Yeah.
But if the holding company owns the shares and then it sells the shares to a third party and all that money goes into the holding company, no tax to pay.
No tax.
That's
No tax at that point in time. But of course, if you want to personally draw that money, then there's taxable charge.
Then you've got the tax, yeah.
Unless, of course, you decide you're going to go into the yacht charter business, for example, then you set up a new limited company to buy the yachts that you're going to be spending the next 10 years chartering out. You know, so yes. Living and breathing your business is always the best tax avoidance that you can ever imagine, Ahmed. So we've got some questions here. Could you table the question of whether investing in a limited company makes any sense? Most investors are using SPV, which is nothing more than limited company, for financial taxation purposes. But when I projected my portfolio take-home pay, it never really made any financial taxation sense to use a limited company, because my take-home pay is less. Say you keep accumulating gains and huge capital asset over 30 years, say you have £20 million, there's double taxation to deal with. Surely a limited company does not make financial sense for most. Because most gains over many years are from capital gain, surely in personal name is better, as all equity released through refinancing is taxed at 0%. I don't know if you can read that in the chat.
Yes, I can, and I can see where I think the name is June or June. So
yeah,
forgive me if I pronounce it incorrectly. The key takeaway from the example, and the question is, every situation is different. So one size doesn't fit all, which I know what I said at the start. But I think June is, to some extent, mixing two different things together. One is income, i.e. profits, pay tax, and then take income personally. The other one is capital gains tax, which is the appreciation in the value of your shares or the value of your business. Two very different things. So the example that I gave Bilal in terms of reducing his capital gains tax is one possibility. But the second one, Jun, which Rupert's already kindly covered, is if you make a capital gain by having sold your shares to somebody else, you can then, of course, claim entrepreneurship for business asset disposal relief and only pay 10% tax on up to a £1 million in terms of your lifetime limit for business asset disposal relief. So income and capital gain are two different things. And generally speaking, as your company gets bigger in terms of profits, what most people tend to do is they take a baseline income, again, depending on their personal needs, and then they leave most of the money there. So let's run through an example. If a company is making £100,000 profit, let's just say, and somebody needs £30,000 for their personal lifestyle, personal income, just as an example, they would obviously take that out by way of a salary and then a small dividend. So the salary could be, let's say, £10,000. Usually nowadays it's £9,500 to avoid personal tax and national insurance. But let's just say it's £10,000, then they would take the other £20,000 as a dividend. Then they would leave the £70,000 in their business and then reinvest that to obviously grow those profits. If you had that same business in your own name, on the £100,000, you're going to use up your personal allowance, then you're going to pay 20% basic rate tax. That takes you to £50,000. Then the second £50,000, you're going to pay 40% tax. So it makes no sense for you to have that business in your own name. It's much better to have it in a limited company. Now, Now, of course, if you need 80 or 90,000 pounds, then we need to run through the sums and work out if it's better in your name or a limited company. But as a general rule, the bigger the profits, the more benefit you have of running it through a limited company.
Yeah, and it's quite confusing for property investors, of course, because property investors are a strange breed of investors in many ways, shapes and forms, because the whole idea, the original idea of investment is that you have something and you invest it. So you have the money in the first place and you invest that money for a gain or maybe dividends, and it's not really, it's something that happens alongside, something that happens in the evenings, you know, and you have your normal job or what you do. But of course, a lot of property people, not only do they leverage up to a point where they're hardly investing any of their own money in the first place, but they're also in a situation where they become self-employed individuals within that discipline. And so you have some property investors out there who are literally requiring the proceeds of the rent and everything in order to just to put, you know, to cover their monthly outgoings. And there are other investors out there for whom all of the returns that are coming in are just purely investment returns and stay as savings or investments, you know. And I think that the great rule of thumb, and I think I need to credit Mark Alexander for this, and it was a number of years ago, that he said just basically, if the majority of your rent, if you're spending it personally, i.e. you need it to live on, then probably incorporation is not right for you. Whereas if your investment money is basically your savings and you're just doing the best you can to get the best return on your savings and you don't need that to live on, then you can structure your affairs in a way that perhaps a limited company would be a much better way of doing it. Would you agree with that, Shaz?
100%. So I know Mark, and Mark and I are usually on the same page when it comes to tax and, of course, on investment. So he's absolutely right, because obviously if you don't need most of the money and you're going to recycle it, then why would you want to expose that to the higher rate of tax, which is 40%, or the additional tax of 45%? You want to leave it in a corporate wrapper, i.e. a limited company, and only pay 19% corporation tax. But obviously if you need most of those funds for yourself, then it may be worth having the business in your own name. But again, run through the sums just to make sure that works. And of course, 5 or 6 years ago, Rupert, you will recall, if you took dividends using up your basic rate of tax, there was a notional tax, but you never paid any tax. Now we've got this 7.5% we're having to pay, and as you spoke about earlier, corporation tax might go up to 25%. The Chancellor very early on during COVID made it very clear that he is looking to equalize tax between closed companies, i.e. Shareholders and directors who own a company versus employees or sole traders and partnerships. So what it basically means is if you have a limited company and you're the shareholder and director, going forward, you're going to have to pay more tax. Yeah. And I think one of the ways he might do that is he might increase the rate of tax on dividends.
Yeah, and I said it earlier, and please take this away. You know, there is a strong likelihood that tax revenues are going to go up. That tax your tax rates are going to go up, whatever structure you're in the future. And these capital allowances are at the moment, you know, something to really consider as an opportunity for you, particularly if you are looking at purchasing commercial property, which could be a very, very good investment. As I mean, all properties are you're going to likely find some good deals across the whole spectrum of property, but very much so it will be the case in the commercial area. So that's something of interest. I just would like, you know, we've got about 10 minutes left, and there's no other questions on the thing, but I think it'd be interesting, Shaz, for us to just hear it from you about the differences with the trading element of business and the investment element of business. And particularly, this is something that we've had to, a lot of people have had to do through the COVID situation, where they've had serviced accommodation units, which have been very profitable, and then suddenly they've had to close them down. Then they've had to repurpose these service accommodations by maybe putting a tenant in on an AST. So this shifts that quite dramatically, doesn't it? So can you tell us, and maybe that people are going to be doing the opposite in the next few months as well. So can you talk us through that?
Yeah, so if people have a, say, buy-to-let property or a commercial property that they turn into service accommodation, that's usually when the advantages kick in terms of course, being able to claim capital allowances on the existing building, plus obviously any refurbishment costs, which is a big win. Section 24 doesn't affect serviced accommodation as long as you meet the tax rules, and any income that you generate through your serviced accommodation business, you can move into a SAS. Obviously, you've got your £40,000 annual limit per person. Now, if you go the other way around, where serviced accommodation now becomes buy-to-let, one of the big challenges is, unless let's say it becomes a single buy-to-let or a single let, if you've claimed capital allowances, when it becomes a single let, you can't claim capital allowances. That's when you've got the issue that we talked about earlier, which is that you're going to have a balancing charge if you've claimed capital allowances on the property. And I had a guy, in fact, Rupert, just before COVID, and he'd actually done this, and the exact specific detail escapes my mind. It was about January time, and he'd kind of done this without realizing, through advice from his accountant, and HMRC looked into it. He had a £250,000 tax bill, ginormous tax bill, and he basically wanted to know what he could do with it. And obviously, you'll know, Rupert, is there's not much we can do after the event usually, especially when it comes to tax. So unfortunately, we weren't able to help him. It was too late. So the balancing charge is something to be aware of. Of course, the other thing then is Section 24 will come back into play. That's something to be aware of. If you're making pension contributions, that's something to be aware of, because you can't use your buy-to-let profits towards that £40,000 limit. So those are some of the things people need to be aware of if obviously their service accommodation business has now become a buy-to-let business. Then of course, the other big one, if they were to sell their service accommodation business to a third party, they can claim entrepreneur's relief, which is now obviously called business asset disposal relief. But if it becomes a buy-to-let, then that becomes problematic. They're going to lose that as an advantage. And again, depending on their business structure, if we're talking about a limited company, then I talked about earlier in terms of the substantial shareholding exemption, they're going to lose that. So that's going to be a problem. Then you've got business relief for inheritance tax purposes. You may possibly qualify for that through your service accommodation business for your properties. You definitely don't qualify for it from your buy-to-let properties. So in a nutshell, to kind of answer your question, Rupert, without you having asked it, is that if you have a buy-to-let business and it's an investment business, you get less tax advantages compared to a trading business. So if you're doing commercial conversions, if you're building new homes and you're selling them, you're refurbishing, selling, you're flipping, you're doing service accommodation, and you meet the tax rules, all of those are then treated as trading businesses. Service accommodation doesn't become a trade, but it's treated as a trading business for certain tax purposes. You get more tax advantages. If you're a buy-to-let, you get less tax advantages. So moving from service accommodation to buy-to-let has serious consequences depending on what you've done in the business.
Well, that's really interesting. And it's amazing how quickly time goes when you start talking about tax, Shaz. I've just got one little question of my own here, which I don't know if it actually makes any difference, but if you are a development company or a company that goes about its business buying up houses and then maybe refurbishing them a little bit and then selling them, and you're doing that on a repeating basis as a business, are those houses that you're buying are they assets or are they stock, or does it not matter?
Depends. So if you're in the business of refurbing or refurbishing and then selling properties, then you are going to be a trading business, and those assets are going to be stock, which is good in one sense because then you get the benefits of a trading business. But you can't then claim capital allowances on those, because you can only claim capital allowances on something which is a fixed asset with plant and machinery, etc. So if that item is a stock item, you can't claim capital allowances. I know that wasn't your question, but I thought because we've talked so much about capital allowances.
Very interesting. It was part of the question, which is really, does it matter? I mean, whether it's an asset or a stock, and yes. Would HMRC be actually defining it as one or the other in that regard?
Yes, they would. So if you're flipping, then it's going to be stock. If you're buying properties, renting them out, and then selling them every so often, then it's going to be an asset. Okay,
because on a related note, one of these bounce back loans, it was Santander, have got an agreement that you sign in order to get the loan, and one of the terms of the agreements is you can't use this money to buy fixed assets. But of course, it doesn't go into any detail or make any mention about using the money for stock. And this was a conversation that we were having a few weeks ago when this situation came out. So very, very interesting that you know, that definition there between, you know, exactly the same property could be an asset to one person or one company and could be stock to another, just depending on that activity.
Absolutely. So I think, yeah, so if it were a stock item and you're flipping and you use the bounce back loan to further the business to buy another property to flip on, yeah. I think on balance, you'll be okay because you're doing what you've always done. If you were to use those funds to buy an asset, i.e. buy further property, then I think there might be an issue, especially if there's a default and the government step in to have a look and tell their liquidators or administrators to look at the transaction and see what's going on. I've had one person who's not a client as such on Facebook telling me that they got the bounce back loan, transferred it to a different account. The bank picked up and I said, hold on a moment, why have we transferred the funds? Can you bring them back into the company?
Yeah, interesting. And you know, before we open that can of worms, this was particularly on the Santander one, and I'm very aware that other banks, because we got one with Lloyd's, that they have different conditions or different. So every bank is, I don't think these are government rules as such on this. Is each bank are actually setting their own conditions when they're lending on that. Listen, this has been absolutely fascinating, and we're coming up to the hour mark now. So there's no other question. Well, the final question that we've got from Rachel, who I know would be a very good client to anybody. She's saying, Shaz, are you taking on any new clients? So could you just tell us a little bit about your practice and also about your book and everything? And as a thank you to you, we can give you a chance to tell us all and promote your services as far as that's concerned.
Be delighted, and seeing that Rachel has asked so nicely and worded the question so nicely, Rupert, the answer is yes, we are taking on new clients. So as a firm, we specialize in working with, well, predominantly working with property investors. I'm a property investor myself. I do share a lot about some of the deals that I'm doing. So Rupert, with your permission, I hope you don't mind, I
Please
have
do.
a Facebook group called Entrust Property Tax Experts, where we talk about two things and two things only. One is obviously property and property development, and the other one is property tax. So if you want to be part of the group, please join it. It's a closed group, but if you just let me know that you are on this call here, more than happy to allow you to come into the group. So as a firm, we specialize in working with property investors. We've got accountants, bookkeepers, tax advisors, VAT specialists. I also have a stamp duty land tax specialist who works with me. So anything pretty much to do with property and tax, we do it. And just as a very quick side note, we do a lot of work on stamp duty land tax, whether it's buying through probate, buying 2 or more properties, buying a house with a granny annex and claiming multiple dwellings relief. There are loads of different reliefs, buying a property which is uninhabitable. And Rupert, we come across a lot of people who've overpaid stamp duty land tax. So if anybody who's on this call today who's bought property, especially in the last 12 months, and thinks it was uninhabitable, or they bought it through probate, or they had a granny annex, or something like that, please run it past us or past me. I'll have a look at it for you. There could be a possibility we could claim back that stamp duty land tax for you. If somebody wants to contact me, the best way to do it is you can call the office, but because due to COVID, everybody's working from home. But the phone number is 01733 555 667, and my email address is Shaz, SHAZ, at AA, so AA accountants.co.uk. Rupert, if you would be kind enough to put that in the message or the chat box, or I can type it in now.
If you could, I tried to, but I'm fearful of making a mistake.
I will happily do that. So I'm happy for anybody on the call today.
And we'll put that on the YouTube comments as well. And just in terms of how do you engage with clients? Is this a sort of a retained engagement, or is it a per transaction type of engagement?
So good question. So it depends. Sometimes people may have a one-off transaction. For example, there's a stamp duty land tax issue. That's going to be one-off. If there's an inheritance tax issue, that could be a one-off. But generally speaking, sometimes we do a one-off piece of work, and as you'd expect, they then end up becoming clients and we do more and other work for them. For most people, because they're in the world of property, they generally tend to engage us from day one, and then we have an ongoing relationship where we agree a fee to do their tax returns, account, VAT, payroll, CIS, whatever it might be, and then they pay us on a monthly basis.
Yeah, I understand. No, that's excellent. That's excellent stuff. And I don't know, we spend a lot of our time trying to make the money, and sometimes we just let loads of it slip by just by not getting the structures right. So it's so important to really understand your tax, and be well advised on the tax side of things. So listen, that's been absolutely fantastic. Thank you very much, Shaz. It's been an absolute pleasure. So this video will be put up on the YouTube, the Unity YouTube channel. And if anybody has any further questions, they want to come on and ask me via the Unity Facebook group or Shaz's Entrust Property Tax group, then please do. Thanks very much indeed.
Thank you for having me, Rupert. It's been an absolute pleasure, my friend.
Thank you.